Our second example involves the concept of amortization or the accounting convention of recognizing an intangible asset such as prepaid insurance, consumption, or use over its useful life. Remember that the broad definition of an asset is something with a future value. Therefore, when an asset, intangible or otherwise, loses its value over time, that loss of value must be recognized as an expense, which represents the quantification of the loss. So in our second example, let's say a $12,000 annual business insurance policy was purchased on January 1st, 2013 and set up as an accounts payable, that is, a liability to be paid at a later date. Now, I want you to pause a second and think about how you would record the first part of the transaction. As I indicated, a $12,000 annual business insurance policy was purchased on January 1st, 2013 to be paid at a later date, and since an annual policy, its useful life is 12 months or January to December 2013. So what would be the first thing you would do? Well, since it's an accounts payable, the first part of the transaction would be to go to vendors, enter bills. Let's say we bought the insurance policy from Sargent Insurance. As we said in our example, the date was January 1st, 2013, so this is the date we put in, and let's say the reference number for this policy was AZ12345. And as we said already, the amount we paid up for this annual policy was $12,000. The memo we could put in is 2013 business insurance policy, and now the first question I want to ask you is this. What account would you associate this purchase with? Let's first think about what we purchased. An insurance policy is an intangible asset since it provides us with a future benefit, which in our example is 12 months. So on the first day of the policy, we have a future value for the other 364 days of the year. Therefore, the account we need to record this purchase must be some asset type of account. In fact, since our asset will last a year or less, it would be considered a current asset, and if we go to our account drop-down menu and look at the current asset type choices available, we would find the best choice is probably the current asset called prepaid insurance. Prepaid insurance is a commonly termed account to represent the notion that you have paid up front for an asset that is yet to be used or consumed. So let's pick this account and put $12,000 in the amount field. We'll leave the memo, customer, job, and class fields blank for our example. So at this point, if we went to the balance sheet to see our financial position as of January 1st, 2013, we would see that our prepaid insurance account has been increased by $12,000 as a debit, and that our accounts payable account has also increased by $12,000 as a credit. If we went back to our debit-credit matrix we introduced in our last example, we would see this makes sense in terms of what should have been debited and what should have been credited. Again, since an asset, prepaid insurance, was increased, it's a debit, and since a liability, accounts payable, was increased, it's a credit. Now, if I asked you what would happen if we never did anything again regarding this asset, how long would the prepaid insurance asset account reflect the $12,000 increase? If you answered it would reflect the increase forever, if we never did anything again, you'd be correct. But what is the truth as to what is happening? The economic reality is the value of the prepaid insurance asset is losing value every month. And how much value is being lost each month? As we said before, the $12,000 prepaid insurance asset has a useful life of 1 year or 12 months. So it's losing $1,000 a month based on our estimate. So how do we reflect this in QuickBooks? If you answered by using a journal entry, you are correct again. So now let's go through how you would set up this journal entry. Again, to open up a journal entry, go to Company, Make General Journal Entries. Let's date our journal entry for January 31st, 2013, since this represents the end of our first month of using the new asset we purchased, and therefore the first month of amortization. Since we said our amortization is going to be $1,000 a month, and we know that debits have to equal credits, we could start out with this journal entry by putting in $1,000 in both the debit and credit fields. Now the question is, what account do we debit and what account do we credit? Since we know one of the accounts is amortization, which is a type of expense, would this be a debit or a credit? Well, let's go back to our debit-credit matrix. If we look at our matrix and look for the expense type of account, we can see when we increase an expense, it would be a debit. So let's go back to our journal entry and put the amortization expense account where we've debited $1,000. Now, what account would be credited? Since our asset, the prepaid insurance, is losing value each month, and we are recognizing the loss or expense through amortization, the offsetting credit entry must reduce the value of the prepaid insurance asset. Notice we are in balance, and our entry will make our accounting records correct. We can now put in a memo, class if we want, and assign each line to a customer job if we want, and then we can save this entry by clicking on the Save and Close or the Save and New. But before we do this, let's again think about a way of saving us a lot of work down the road. Remember that we said the prepaid insurance we purchased has a life of 1 year or 12 months, and we just now only recorded the first month of amortization expense and reduction of the current asset's value. Well, this would mean I have to make this entry 11 more times, which is a lot of individual entries I would have to make unless we do what? Hopefully you recognize we can memorize this entry so we don't have to do this entry manually again and again. We discussed how to memorize a transaction in Lesson 4, but just as a refresher, you can memorize this journal entry by going to the taskbar on top, and you can click on the Memorize icon and complete the Memorize transaction window. So you would put in a name like monthly amortization for prepaid insurance. Then I like to select Automate Transaction Entry, so I will be reminded to accept the entry each period when it is due. And then I would select from the How Often drop-down menu how often I wanted this entry to occur, which would be monthly in our case. Then you can put in the next date, which would be 2/28/2013, since our first entry that we still need to save is 1/31/2013. Then finally, you can put in how many are remaining, which would be 11 in our case. And if I wanted to be reminded so many days before it is due, I can put in whatever number of days I want in the days in advance to enter field. Once I click on OK, the memorized entry will be saved, and then I need to save my original entry. Now I'm done with all the setup I need to do for my journal entry to reflect the amortization of the prepaid insurance asset I purchased. Also, I wanted to share with you, just so that you understand how this entry affects the related financial statements, a look at the profit and loss statement in January and see the amortization expense side of the journal entry, which is here. And if we drill down on the amount for the month, we see the debit side of the entry. And then let's go to the balance sheet and see that the prepaid insurance account was decreased by $1,000 as evidenced. If we drill down on the $1,000 credit entry we made in our journal entry, we will do a final example in the next exercise to look at how you would handle with journal entries being paid upfront for sales that have not yet occurred.